Folks, I've had enough. It's time to do a deep dive on an interest-only loan product, sub 7%. So, folks, I have Jonathan and Dustin, who are the ones that have this private money, private opportunity to do this. So let's them define what they got. Who wants to start?
Dustin can start.
Yeah, it's so we've spoken about it. I think 2 or 3 of our last weeks on the show, but today we finally can at least communicate to the audience exactly how we're going to underwrite this and why it'll be beneficial in some situations. So essentially, the interest only product that we have has a lower monthly payment than a fully amortized payment.
No,
right?
Is that how it works? No.
The reason it's important or why right now we're able to save, I mean, I don't know, there's probably been 10 or 15 just in this last week that John and I are specifically working on that we had to flip to interest only just so that the debt coverage would be positive in cash flow.
Right.
And to get into the kind of the nitty gritty, the way that it works essentially is if you're going with the fully amortized loan right now, we have to be either at 1.1 or 1.2.
Wow. Okay. Yep.
But if we do interest only, what we're going to base it off of is, hey, when it goes fully amortized, it just needs to be above 1. So that saves us about 10, 20%. We're still, sure that, when it converts to a fully amortized, that it's still going to be at least cash flow neutral or positive, right? But it's safe.
But again, that's a year. Sorry to cut you off, but that's potentially what, 5 years down the line, or what kind of duration are we talking about?
5, 7, or 10.
Yeah, and that's meaningful. And the reason why that makes sense is, does anybody really think rents will be flat for 5, 7, or 10? Could they be flat for a year? Sure. 2 years? Sure. 5, 7, or 10? Come on, really? I don't think so. So I think that's a wonderful twist. So go ahead, Dustin. Sorry to cut you off.
No, that was exactly kind of where, John and I had been behind the scenes really trying to figure out for all of our clients is, okay, we've got the interest only. We know that it can cash flow better, but what requirements are we going to have with our fund that will let our investors basically say, okay, we'll let you use the interest only payment only if the fully amortized when they get there, it's just cash flow neutral is what I'm calling it. So
yeah. So again, we're talking about a loan product that potentially is below 7% with a lot of assumptions. Reach out to Convoy to figure out your rate, your property, all of that. But again, it is a fixed 30-year product. It's 30-year debt. It's not like they have to be, there's not a balloon payment at 5, 7, or 10, correct?
Correct. Now it's an adjustable. Okay.
All right. That's fair. Yep.
It's a 5-year fix, adjustable year 6 to 30.
Okay, great.
5 years are interest only.
Perfect.
Same as the 7 or the 10, right? The fixed period is the interest only period.
Gotcha. So is there, and again, this could change, right? We're recording this on the 19th of January. Is the rate much different between 5, 7, and 10? Like, are you getting an extra quarter point for 10 years versus 5 or something like that?
Yeah. I mean, I think the 5-year is probably, I mean, that's the one that right now we just quoted. We're still quoting it like 6.6, 6.5. And 7 years, I think like a quarter higher, right?
Yeah.
Yeah. And then 10 years, a half higher.
And that makes sense. Yeah.
Yeah. But I mean, right now in the market that we're in, most people will probably refi in the next 3 years, right? Most likely within the next 3 years, whether it's, to cash out or whether it's just to get out of their current higher rate. So we'll see what happens. But I think in terms of protection wise, because we always want to make sure we're also putting our clients in great deals. Protection wise, it allows for the client to also feel a little more secure that we're underwriting based on fully amortized and interest only, because the interest only still has to cover at 110%, 120%, like Dustin said. So it's a good deal. It's a great deal right now. And in 5 years, if you don't refi, what is it going to turn into? Is it going to remain a good deal, or is it going to turn into crap?
So, who would be the ideal candidate for this? Because I think earlier one of you said you kind of saved 14 or 15 deals in the last couple of weeks by doing this. Is it an investor? Is it a refi or is it purchase? I forget. Is it just one or the other?
So the most common issue we're running into right now is our purchase investor properties, because what happens is our clients are going to buy a property, they're going to get an appraisal, the appraiser is going to put X, whatever amount he thinks the market rent is. Now, most of the times our client and us disagree, we think it's low, right? But in an example, like an actual true example is, I had one client, I think the loan was like 750 or something. The market rent came back at like 3750.
Okay.
The client thought it was worth 4,500. Now, when we ran the fully amortized, right, we were going to basically require the client to bring like 38% down. But when we do an interest only, now he only has to bring 25 down.
There you go.
It saves deals that way.
Yeah. So again, if you're an investor and you're on a deal and rents coming low, appraisal, this is just where we are. Lending, I think, is going to get tighter, and you're going to need the flexibility of things like this. You want to say something, John?
Yeah, the market is quickly tightening. I mean, people think, it was funny, I was talking to a client yesterday. They think the market is kind of like loosening up. Everything's good again. But my thought process always is everyone has such a short-term memory to bad, right? Like that's the mindset, is everyone doesn't realize, like, hey, we're not actually out of the woods yet. We're still in the woods. It might get worse. It might get better.
This is a small clearing.
Yeah. So everyone's kind of acting as if, because we talked right before, like, hey, transactions seem to be going up. But I think it's that people are starting to feel a little more comfortable and moving. But on the next signal of bad news, who knows, right? But so the underwriting aspect, it works for both purchases and refis.
Sure. Okay, good.
Yeah, you do it for both, but Dustin brings up the purchase because usually purchases are on a strict timeline.
Yeah, and you're trying to save those deals. It makes perfect sense to me.
Exactly.
Yeah.
But we can do cash out as well with it. So yeah.
Very, very cool. Well, guys, if somebody wanted to reach out and have this conversation, where should they go?
Go to convoyhomeloans.com and let us know you came from ORAT.
Yep. And then if you do that, you get Jonathan or Dustin, and you will be very, very happy. Thanks, guys.
Thank you.